A merger of two equals, how Capital One and Discover Financial Services are going to be changing the way that we do business with our credit cards and the financial services that we use. Today, we'll be talking about how Discover is pivoting to a new direction with the help of Capital One. Discover Financial Services is a Fortune 500 company that offers an array of financial services to the public. You may know them for offering personal checks, savings, personal loans, and student loans, but they're most notably known for their Discover credit card, the credit card that we all used and love that's available nationwide. There's over 50 million credit card holders in the United States that use Discover, and it's one of the fourth biggest credit card networks that we know of. And what's amazing about Discover is that they're also the issuer of the credit that uses their network. And you ask yourself, well, what's that and why does that matter? Well, Discover, like American Express, they also offer the network fees to merchants to allow them to use their network, but they also provide the credit for consumers to use those products and services. And we asked ourselves, well, where did Discover start? And if we look at the early beginnings of Discover Financial Services, they didn't exist until relatively the mid 1980s. And they originally were co-founded by Sears Roebuck and Company, which is a major retail brand that existed throughout the early 50s, 60s, and 70s, a company that's been around for over 110 years. And now they're a different company today that's available for retail clothing primarily online, since they have no longer have a retail presence that they used to have. But back in the 80s, they started with Sears as a way for Sears to attract new clientele by offering consumers credit to purchase products and goods and services. Now, credit cards hardly existed before the 1950s and available scale, just because credit cards were primarily used for individuals of a certain wealth caliber and business transactions. So by launching Discover Financial Services back when it was called the Sears Financial Network, it has allowed them to have multiple credit locations with their retail locations. But it expanded since then. We look here, Sears has built a brand throughout the years over its 35-year history, and it used to offer and sell financial products and services to their consumers and to help compete across the retail market with brands like JCPenney and Walmart. Since then, Discover Credit Card has launched from 1985 in test markets known as San Diego, California, and Atlanta, Georgia. Now, what made them different than the others is that Discover, unlike other major retail credit cards, did not charge an annual fee in order to use their credit, which was nice because other lenders like Visa, Bank Card from Bank of America, and MasterCard charge an annual fee in order to use their credit. So this allowed them to gain market exposure, gain a new client, and at the same time offer cash back. Now, when we say cash back, now we think of it as synonymous as of today, as most major credit cards offer the option to get cash back rewards or points, right? But back in the 80s, when Discover launched their credit card, it offered up to 5% cash back, which was amazing value at a time when they were trying to revitalize and join a new market and trend, being the last outlier in the credit card issuing company. Now, over that time frame, we look at Sears and how they helped debut the Discover card. And they made it their own card on January 8th, 1986, that they announced that they were going to offer this card for the masses. So you can use this card outside of Sears and use it as a traditional credit card, which was great. This allowed them to increase the amount of customers that they're able to serve and use it in other retail to merchants, like when you go get groceries, when you go fix your tire, you had to go put gas. So this allowed a new market opportunity to unfold with Sears and allowed them to expand into the financial industry. And as we continue to look, Discover Financial Services today continues to set the retail experience in banking. And Capital One wants to acquire Discover because the way that Discover Financial Services continues to lead in its all class customer service experience from the beginning to the middle and end. Now we look here how Discover is a game changer in the industry because they put their customers first and where customers matter by making sure that they create a positive, friendly, and welcoming experience throughout the entire process from the moment you walk into the merchant to the moment that you swipe or use the card. And while you pay your bill, they make hassle-free payment options online, over the phone, and with a real human being. As we watch and take a closer look into this video, we can see why this guy Discover Financial Services changes the way that we do business by meeting us at our most needed times. Let's take a look at this video.
Discover Customer Service, this is Maya.
Oh, hi, Maya. You robots are sounding more human every day.
Oh, I am human.
Yeah, it's like I'm talking to a human.
At Discover, everyone can talk to a human representative.
All right, prove it.
Wait, are you a robot?
Oh. How would I prove that I'm not?
24/7 US-based customer service.
Do you feel like a robot?
It pays to Discover.
After we watch that short clip there, and it just shows us that how the customer pain points that Discover is wanting to solve. And the first and foremost is by retail and in-person communications. Since Discover Financial Services operates primarily online and they work with their merchants to allow their products and services to thrive, when customers that are using the card need help by reviewing a billing statement, that they need help to review some clarification, when they call their customer service number, they're not just presented with a robot with a myriad of options and menus. You can have the opportunity to speak to someone here locally in the United States in person and in real time, which is great. And that's one of the few pain points that Discover is differentiating from the likes of Synchrony Bank, from Bank of America, Wells Fargo, and other credit card lending facilities and companies. And as we continue to watch this next video here, we'll
Discover
understand
customer-
why as well. Now, when they talk about they always have options to talk, this just shows us a quick example how we as consumers can sometimes mistake how these preconceived notions when we need to contact help and support, thinking that we're only have the opportunity to receive a robotic system or message.
Discover Card, how can I help you?
Oh, you're real?
You know I'm real. With our new card, we're always here to talk.
Well, that's good, because I don't have time for machines.
Some companies just don't appreciate the power of conversation.
Real people.
Mm-hmm.
It's like I'm calling the land of machines.
With that robot voice.
Oh, I don't like those machines. Oh,
How can I help you?
oh. I don't even remember.
At Discover, we treat you like you'd treat you. Talk to a real person.
And that just commercial shows to highlight how Discover is continuing today in 2024, allowing us to communicate with a representative in real time and with a real person and not with an automated machine. Now, as we look forward here, we'll take a look how Discover is accepted everywhere throughout the United States and worldwide. You know, over 99% of merchants accept Discover credit cards. And when you use your American Express, your MasterCard or Visa, you more than likely can use Discover. And this is proving to us that they can enter a new market and continue to manage that customer service experience and approach by allowing them to remain competitive and be accepted where you need them the most. And as we look at today, Discover Financial Services has expanded year over year into new and emerging markets. They had the opportunity to expand to Russia. They had the opportunity to expand to Colombia and other locations worldwide. As we look at this here, this just allows us to know that Discover is here to stay and they're willing to change and adapt to the needs of the market and the customers that they serve. Now, the two main differences between Discover Financial Services, Visa, and MasterCard is that when you use a Visa or MasterCard, these are credit card networks, which is different. Since these credit card networks are issued by banks, which are Wells Fargo, Bank of America, and other banking institutions, where MasterCard and Visa collect a licensing fee in exchange for the rights to issue the cards using their name and systems. So when you go to a retail center and you use a card that has MasterCard, it's not MasterCard that's giving you that credit, it's the bank that you're using it with. And so that's a key differentiator between Visa and MasterCard and how Discover and American Express are different. Now, when we use a Discover or an American Express card, they're both separate companies, but they kind of work the same way. So when you swipe that card or use that credit card, when you're purchasing an item or service or good on the Discover card, it's charging Discover what you purchased and you pay Discover directly back. So instead of using the interbanking fees that they charge to the banks, they can pass on those savings by giving you more rewards since you're purchasing that item on that card, which issues that same credit. So when we both rely on these transaction fees, they do not need to use or report the amount of balances to the banks, and you have a direct relationship with Discover and American Express, which this allows Discover and American Express to make money off the interest from the customer because the customer is more than likely not wanting to pay the balance in full each month since they charge competitive interest rates. And if we look at the world's trend on our 2022 average credit card transactions, you can see that a lot of individuals use American Express, MasterCard, Visa, and Discover. Now, if we look at the dollar amount for each transaction, Discover does have a lower amount compared to the likes of Visa or MasterCard. But when we look at the credit volume on the over history and time, that there's over $3 billion in credit card purchases made on Visa and about 1.5 made on MasterCard, about 1 million on American Express, and about 500,000 made on Discover. Now, when we look at these numbers overall, that it is a big amount, but because Discover and American Express are the ones that directly issue the debt, they're more profitable than MasterCard and Visa because Visa and MasterCard has to pass on those charges to the banks that they work with to issue those cards. Now, this created a change in the market and industry because we look at the world today with Capital One announced and their decision to purchase Discover Financial in a $35.3 billion all-stock deal that was announced in February 2024. Capital One says that this merger with Discover is going to create more change in the credit card industry to benefit consumers and the businesses that they serve. And they did this at a time when consumers are looking for ways to find easier ways to pay for methods and goods online, in person, in a more secure and a more accessible approach. And the mega powerhouse that in consumer banking and lending, which is Capital One, said that they will bring an new life into the credit card industry by boldly positioning themselves as a card of all cards and entering to an audience that previously has been critical of such products. Now, consumers today are aware of the charges that they get, that the goods that they purchase, and the things that they need. And they're figuring out if they're wanting to pay cash using a debit card or a credit card to cover that. So Capital One wants to make themselves more flexible and more approachable to the millennials, to the Gen Zers, and to their next generation that has been kind of apprehensive against credit cards. And so with the intention to allow Discover to merge with them, they believe that they can continue to create a positive and welcoming experience by changing the way that we do banking. Now, Capital One says that they're the banks of all banks since they're the biggest credit card issuer in the country. And we think about volume and amount of charges. Capital One offers more than just credit cards, quite frankly. They offer auto loans, they offer bank loans. You can get a checking and savings account. You can even purchase a card directly in a Capital One app. So they're a little bit different than the banks of Visa and MasterCard. But the intentions with the merger is that they are going to continue to stay motivated and find ways to offer Discover financial services and products to a new generation. And if we look at the ability that the way consumers can connect with our banks and the things that we use every day, Discover says that they want to stay connected first with the customer and in a digital approach. So you have the ability to view your balances in a more accessible way using your smartphone and mobile devices like an iPad to check your balances, use your iPhone to make a payment, or even receive payments by using digital payment wallets like Apple Pay or Tap to Pay. And we'll continue to take a look here how Capital One changes the way that they do business too in this video.
Why do some credit cards take a simple idea like cashback and complicate it by limiting where you earn bonus cash back. And then change those places every few months. Enough is enough. You need the Quicksilver card from Capital One. With Quicksilver, you've always earned unlimited 1.5% cash back on every purchase everywhere. It doesn't get much simpler than that. What's in your wallet?
As we look at that video with renowned actor Samuel L. Jackson with Capital One, they say that you can earn cash back the way you want it and use it how you feel like it. Now, this video just shows that Capital One is trying to attract a new audience by letting them know that they can always earn cash back, whether the amount, regardless of where you use that card, whether it's at a restaurant, it's at a store, it's at a home goods store, you can use it online and in store and still earn 1.5% cash back. Now, America is on the cusp of the new biggest credit card company, and we're going to figure out what that means for us, right, as consumers. Now, when Capital One announced their intentions to merge with Discover Financial, they said that it will create choices for consumers by offering them more ways to pay and more ways to use their card. Now, the merger is supposed to create more competition across the banking industry, so the competitors can figure out how they can differentiate themselves from Capital One and Discover. But Capital One announced that their consumers will pay less fees throughout the life of their card, since they're able to pass on those savings and rewards to the customers directly, since they don't have to charge the merchants certain types of fees or the customer certain types of fees. And so this allows the consumer to win. But at the same time, businesses that use the Discover or Capital One network, they get access to untapped potential with new customers to increase their revenue as well. Now, Capital One is boosting Discover by moving them forward as a larger company, since they have the financial capacity to compete against the other big rivals. Now, there is a true change, and we look here in this chart with the total U.S. household credit card debt. It has increased each year over year due to certain economic conditions that we face as consumers. And the good news for Capital One and Discover is because a credit card debt is an all-time high, that's surpassing over $1 trillion in debt for the first time since in 2023, Discover relies on the ways that they make money to generate revenue based off the interest and the balances that customers hold. And since we look at over 57 million cards are in existence, this is an opportunity for Discover to figure out ways to issue more clientele with these cards, but also make more money, right? Now, the good news is that customers love Discover cards. And when we look at the J.D. Power's U.S. Index for Customer Satisfaction, and these are KPIs, or what are called Key Performance Index scores, where they ask consumers how well do they enjoy their cards, how well are they likely to recommend them to their friends and family, and how will they continue to use them. We look at Discover, and Discover leads the way with a 842 basis points in terms of customer satisfaction, which is phenomenal in the age of digital transactions. And American Express and Capital One are right beneath them. So this shows you that Capital One really wants to have Discover because they are creating a friendly and welcoming atmosphere, and customers continue to love them based off of myriad of factors. And this just shows us how, with the power of doing things good, allowing customers to have choices, involving your customers in the transactions that they do, that you're going to create a positive and welcoming experience throughout the way. And as we end this here, I had the opportunity to be on Fox News Radio with Jessica and Dave to just talk about just this. And we'll watch this interview and enjoy it together. Hi, Jessica. How are you? Wonderful. Thank you. Happy to hear. Yes, and I'm glad that you brought me on today so we can dive in deeper to figure out what's going on. I know that you and your colleagues mentioned this is a really interesting dynamic when we're dealing with two big financial institutions that are wanting to merge together, right? And it is important, we have some news that we're going to cover tonight. We're going to look about it a little further and what that means to consumers, what that means for businesses and the users that use both networks, right? And we're going to take a little review and figure out what the challenges are, what the benefits are, and what are the differences. Mhm. You're definitely spot on, and you're right on the nail. So I'm glad that you asked that question. But it is interesting, Capital One, major powerhouse in terms of credit card issuing, and the network announced that they were going to be merging together with Discover Financial this past Monday. And the deal is supposed to be the two largest credit card companies in the United States. And that's just in the US alone. Capital One is available in other areas outside the US, and so is Discover. But we're just talking about in the United States, just to give a little local perspective when it comes to that, right? hmm And you're right, there is some regulatory scrutiny, heavy regulatory scrutiny, in a local level, state level, and a national level. And currently with the administration that we have right now, they are going to be taking a deeper look into this and how this is going to affect businesses, consumers, most importantly, the individuals that are using these two financial services. You're right. hmm And here's what's interesting is that the deal is worth and valued over $35 billion. And the benefit of Capital One wanting to access Discover, not just because Discover houses their own credit lending facility, but they also are the issuer and the network behind it. And you're asking, well, what's the network and what's the difference? What can consumers use? Well, we all know we have Visa, MasterCard, American Express, and Discover, who are the four main networks that are used across businesses and consumers in the United States when they're accessing financial services, from banking, from making goods and purchases online, and when you're filling up inside the store, for some groceries or getting some gas. And so, but what the key differences are that these financial institutions such as Bank of America, Barclays, and all the others use and rely on Visa and MasterCard as their internetworking processing fees, right? Behind the end, the consumer doesn't know that they pay a portion of that purchase goes to Visa, goes to MasterCard, and goes to the banks themselves, right? They collect a small interchange fee is what we call it. And that interchange fee can be as low as $1 up to $15, some several $100s, depending on the amount that you're using. So Capital One is about profit. It's about revenue. It's about keeping their investors happy, right? And so with this deal, it's going to allow Discover to not just leverage the network behind it, but allow to pass the savings on to consumers as what they say, right? Yeah, it's a mouthful. Definitely. It's a lot of things to consider, right? hmm But what's different, Jennifer, is that the Capital One has access to a credit card network with more than 300 million cardholders and an existing customer base of 100 million. So I want you to put that into perspective, right? When we're dealing with customers and we're issuing these cards to consumers, that's a lot of people that they're going to impact. And that's just in the US alone, right? Yeah, you're right. Capital One is the fourth largest credit card issuer in the year. They have over 122 billion in outstanding receivable payments. And so that makes them the sixth largest bank and financial lender in the US alone, according to Nielsen. You're right. There are other players, right? We have JP Morgan Chase, which they have over 191 million in credit card loans alone, not accounting for stock, bonds, mortgage-backed securities, auto loans, and other traditional lending, that's short-term or long-term lending. And that's just for the consumers, not including the business sector that they also focus at. You're right. And that's what makes it very difficult, especially in today's economy, when we're dealing with inflationary pressures, the cost of goods going up. The average American is bringing home money, but where that money is being utilized, right? And when you're dealing with different socioeconomic factors, people are having to, reach out to a friend for cash or make ends meet, especially, single family earners, and having to take care of children and other costs. They may have to use their credit card for that purchase. So what is the financial implications to that? And how does this better the consumers, You're right. And that's one thing I want Jessica to talk about as well. Yeah, Dave. Mhm. Well, here's a statistic I will share is that the credit card debt in the United States has soared exponentially as more Americans are trying to cover the rising cost of inflation. They're shifting away from using cash to pay their goods and common household items. If they have to fix their car, they're just one paycheck away from having to afford that or not, right? And then they're going to have to use a credit card to fix that. And that can be as low as a few hundred, a couple hundred to a few thousand, depending on what the repairs need to get done. And if they don't have that in their savings, then where are they going to be getting that access to that cash? More than likely their credit cards, where they're already paying higher interest rates, higher payments. And how are they able to meet those obligations when they're already having to deal with the cost of food going up, restaurants are going up, other factors are going up, their electricity and utility bills, because we're moving to this a more conscious, more renewable power sources that people don't have the full access to, nor the states are fully implementing them right now because there's a lot of challenges with that. You're right. Mhm. Now, and that's the key question. Will regulators approve this transaction? And this is not just in the US, this is all across throughout the entire United States, Mexico, and Canada. This will be affecting in those regions, but also in other regions throughout the internationally as well. You're right. Now, you're true. Yeah. In South America, there's not that big of a presence of Capital One or Discover, but that's an emerging market, an opportunity that they can use to leverage to expand their operations, right? If Capital One wants to help lower the interchange fee, they're going to allow small, medium-sized businesses that didn't otherwise have access to that new clientele, have that method of pay. You're right. So true. Yeah, and the few things that they're going to need to approve that is just the two companies just cannot merge without signing off from bank regulators. As most importantly, the Justice Department and the Federal Trade Commission are going to be reviewing this inch by inch to figure out if this is something that they want to allow to proceed forward. It is going to be beneficial to the American consumer. And at the same time, what about a monopolistic approach, right? Is this going to be considered one of those textbook cases that we learn in school, or is this going to be fair to the consumer as at the everyday, you know? Yeah, definitely. And it's going to face real hurdles. Yeah, just because this is the biggest questions that regulators are want to know is if this combined company will have too much influence over the pricing, the availability of services in which it operates, right? So true. And and the antitrust officials are going to keep a close eye on online payment providers, and just to give you some historical context, in 2020, the Justice Department sued to block a merger between Visa and Plaid. It's a company that allowed for online verification and banking systems. If you're signing up for an auto loan online, you're more than likely verifying your income by using Plaid. And so Visa saw this as an opportunity to figure out the financial metrics of other consumers. And so what are the purposes of Visa owning that information, right? When other financial institutions are using that information to run their own credit facilities. So it is something that we want to keep an eye on. And as we move into this phase of AI and augmented reality and digital transactions, you have this new way of currency and you're having to figure out if that makes sense or not. But at the same time, these traditional banks that use cash, more customers are less reliant on cash and using Apple Pay, Google Wallet, and using their debit or credit card, to make transactions. So there's not a physical presence of cash. So a lot of these banking institutions are concerned about what the future holds and what the best next steps are for them to continue to be the powerhouses that they are today, right? So true. And I think it's different than what did happen last year, what we dealt with in Q4 when in San Francisco and California and Palo Alto, they did face the banking crunch when the Silicon Valley Bank went belly up. But that was for other reasons. That wasn't necessarily the credit issuing. They were dealing with investing in these specialty companies that were in AI and other parts of startups, as we like to say, right? And so when there was the access of being able to do online banking and on Twitter now known as X, they started to share that information. And because of that accessibility of doing it that way, a lot of these individuals and investors pulled out their money quickly because they have that ability. It's different than 2008, 2009 with Morgan Stanley or the Lehman Brothers. It did take a little bit longer for them to be insolvent, but this was done practically overnight. When they opened up in the market trading, 5 a.m., 8 a.m. Pacific Standard Time up until that 10 p.m. time frame when they were already insolvent. They realized their books weren't able to cover that cash flow because they invested in bonds and treasuries, which are okay. But because they're long-term securities, they weren't able to quickly turn that into cash. So that is an actual issue that they had to face. And unfortunately, they were absorbed by another bank, and JP Morgan was one of them that took them over, and Signature Bank as well. You're right. But those are two big issues that you are saying is correct, but it is different than Visa and MasterCard and Discover and Capital One when you're comparing it on this level, because right now they're dealing with deposits, they're dealing with savings, they're paying out interest, they have loans. If you look at the financial portfolio when Capital One is investing, they do have a portion of checking accounts, they have savings accounts, they also have credit cards, you're true. That is true. But in the bigger cities, they also play a different role than they do in other areas where people only know them for the credit card access. So true. Yeah, and we do have senators, known as Senator Elizabeth Warren. She's a Democrat from Massachusetts, and she planned to have that deal killed with that merger. And she did voice her opinions because of the anti-competitiveness and what could happen in the financial markets. Yeah, and the Consumer Financial Protection Bureau, which published a report last week, found that these larger mergers like Capital One charged higher annual rates in terms of annual percentage rate, which is what's linked to your card, which is known as to consumers as the interest rate. And they were higher than their local lender in terms of their credit union, in terms of their local community bank. And so when they're looking to get access to cash for $500, are they paying $550, $600? When you're dealing with APR in certain states that isn't capped up to 30, 40, almost 36% for each dollar that they're borrowing. And it accrues not just monthly, but daily because it's a compounding interest factor. You're so right. Mm-hmm. No, I don't think so. But if you look at the larger audience and how long this deal is going to take to get approved, it's going to take a few years, if not 2 to 3 years before the actual implementation of this. No, there's nothing that cardholders need to worry about now from each issuing bank, since they are independently operated companies. They are not using each other for financial services right now, nor do you expect to be in the near future until the deal is closed. And once they're closed, they are going to have their merger synergies, right? Where they're going to start bringing in what's the best for the consumers and for their customers, but their shareholders as well. Well, based off what the letter that was provided to us with the letter of intent, the deal is expected to close sometime in late 2024 or early 2025 at the earliest. So there's a long way from us from knowing about figuring out what the challenges and implications are. Correct. Yes. Well, here's the deal. So just to interject something a little bit different in terms of what was going on, Discover is a credit card facility company, right? Where they issue a form of capital that customers can use, but they did partner with Apple last year and the last 2 years when individuals had what's in their Apple Wallet, which is a form of online banking, when they had an Apple Cash card linked to it. And the payment network that was used behind it was not Discover. It was not correct. Yeah, it was not Discover. It was not a Discover credit card, but a Discover debit card. And that was the first time that Discover was figuring out, making a play for themselves, that this was an avenue that they wanted to pursue further. Yes, but with Goldman Sachs, they're realizing that the Capital One merger may be to their best benefit, because they're wanting to divest and remove consumer lending from their portfolio in terms of investment standpoint, because they have been seeing more losses and revenue come in terms to cover the operating ongoing basis with Apple. Mm. Very true. Yes. And I think there will be more reports as we know more, but this is as far as we know. This is as far as we know right now. Excuse me. Yeah. Yes, Cheryl did make a post about it. You can read more about it on foxbusinessnews.com. You go on fox.com/business to find more. Yes. Well, thank you so much for taking the time to have me on. It was such a pleasure having you and others who will know more about the transaction. Okay.